Hi there, it's Jeff here with a video looking at government bonds. So government bonds essentially are IOUs issued by a government to raise money to fund what they spend. So typically the government borrows money from investors, that could be overseas investors or domestic investors. In return, the government promises to pay back the amount, that's called the principal, after a certain period, and that's called the maturity. Along the way, it pays interest, annual interest, called a coupon. That's normally annually or maybe twice a year. Buying a government bond is basically lending money to the government, and you get interest payments and you get the nominal value of your money back later, assuming the government doesn't default on the loans. Now, in the UK, government bonds are also known as gilts, and bonds are issued into the gilt-edged market. The reason the government borrows, of course, is because typically the amount it spends, in the UK this is shown here in red, is greater than the amount it takes in tax revenues. And you can see that over most years the government in the UK has a budget deficit. Now, traditionally the UK government borrows more long-term than many other countries. The average maturity is about 14 years. That's one of the longest amongst the advanced nations. That means a big amount of the debt that the UK government's borrowing this year, for example, won't need to be repaid or refinanced for a number of years. That gives the UK government, in theory, a bit of breathing room when the market interest rates start going up. The UK government does issue short-term debt too, like treasury bills, which mature. In other words, they're repaid in under a year. So looking at the latest data issued by the Debt Management Office, around 35 or 36% of the debt is short-term, 30% is medium-term, and about 49 billion is long-term. Index-linked gilts account for about 1 in 10%, 11% of the debt issued by the government. That's a special type of UK government bond where the interest, the coupon, and the final repayment, the principal, is linked to the rate of inflation, specifically the Consumer Price Index. Now, issuing index-linked bonds, I think the UK government was the first to do this in the early 1980s, offers investors some protection against inflation. UK government, of course, is running big budget deficits. In 2020, the year of the pandemic, the deficit ballooned to over 13% of GDP, in large part, of course, because the government was funding the furlough scheme and there was a collapse in tax revenues because the economy shrank by over 10%. Now, the budget deficit has come down in recent times. You'd expect that as the economy recovers, but it remains a large one. And this suggests the UK government has a structural budget deficit. The yield on government debt is essentially the interest rate that you have to pay when they issue government bonds. You can see over the last 10-12 years, for most of this period, the yields were falling on 20-year debt, on 10, on 5-year debt. So, for example, in 2020, the UK government was able to borrow money at less than 1% for 20 years. But in recent times, the yields have climbed and they've surged to quite a high level, above 4%, sometimes touching 5%. Partly this is due to the inflation we've seen in recent years. So that's increased the interest rate that the government must pay when it borrows money. As a result, it is spending over £2 billion a week now just in debt interest, in servicing existing accumulated government debt. So that's quite a worrying sign for the government that the cost of borrowing has gone up. One reason is because the UK's credit rating has nudged down. So credit ratings are assessments provided by ratings agencies such as Fitch, Standard & Poor's and Moody's that evaluate a country's ability to repay its debts. You need those ratings because a higher rating, the highest is AAA, indicates a lower risk that could potentially attract investors. Countries with better ratings often enjoy lower interest rates or yields on their debt, and they can also lead to increased foreign direct investment and long-term growth if a country is seen as fiscally stable with a very strong credit rating. Now, there's the ratings again for the UK from the three main ratings agencies. The ratings have come down. We used to have a AAA rating, but no longer. It's now AA. The UK has built up a lot of debt. It's now above 100% of GDP, specifically since the global financial crisis 15, 16 years ago, the COVID pandemic, and major spending like energy support schemes during the cost of living crisis. There's also been a reflection here of the economic and political uncertainty brought about by Brexit reduced investor confidence. A lot of investors are a little less confident now about the long-term strength and resilience of the UK. Credit ratings not helped by occasional political instability. There was a market chaos in the summer and autumn of 2022 with Truss and Kwarteng's mini-budget, which certainly raised doubts about the UK's fiscal discipline. And the new Chancellor, Rachel Reeves, has also faced some criticism from the bond markets for her handling of fiscal policy. The ratings agencies, typically a fairly conservative bunch, they want to see clear, credible plans to manage spending and debt. So there we go. This was a quick primer on UK government bonds.